Good afternoon, friends, colleagues, and communities of Zions Bank. I'm Peaches Chalanga, and I serve our Zions Treasury Management Division. And as a Treasure Valley resident, I serve and support our broader Western Idaho region. I'm going to be your host today. Thank you so much for joining us for our Zions Bank's Economic and Market Outlook webinar for our second quarter of 2022. We present these events quarterly to keep our valued clients and communities up to date with the latest economic and market trends. Our featured speakers are expert leaders Robert Spendlove and Rich Mebius, who we will introduce shortly. We'll begin our event today, though, with opening remarks delivered by Scott Anderson, our president and CEO of Zions Bank. Thank you, Scott.
Thank you, Peaches. And welcome to Zions Bank's second quarter economic and market update. I'm Scott Anderson, President and CEO of Zions Bank. We are excited to present this update on the current conditions in our nation and in our region. In the first 4 months of 2022, we have seen wide swings in our markets and economy, from the Omicron variant of COVID to current disruptions in other parts of the world, especially in China. Furthermore, the Russian invasion of Ukraine in February has caused problems in energy and food markets. The human impacts of these crises far outweigh the economic and market impacts, and we are hopeful that the struggles in other parts of the world will soon improve. But in a global economy, we are all impacted by events that happen around the world. In the United States, the economy continues to grow, but struggles persist. Last week, the Federal Reserve announced a 50 basis point increase in short-term interest rates, on top of a 25 basis point increase in March, and the Fed indicated that more increases are on the way. In announcing the rate increases, the Fed indicated that although overall economic activity edged lower in the first quarter, household spending and business investment remained strong. It also noted that job gains have been robust and the unemployment rate has dropped substantially. However, inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures, according to the Fed. As the Federal Reserve has become more aggressive in addressing inflationary pressures, markets have become more volatile. Bond and equity prices are under downward pressure as they face increasing headwinds. The 30-year fixed-rate mortgage rate reached its highest point since 2009. This is affecting lower income and first-time home buyers, as the combination of increasing home prices and increasing mortgage rates are pricing more people out of the market. While economic and market uncertainty will persist over the next several months, our regional economy continues to be the strongest in the nation. Utah and Idaho lead the country in population growth and employment growth, and have among the lowest unemployment rates of all states. Today, we will hear from Zions Bank senior economist Robert Spendlove, who will give an overview of the economy. Robert will be followed by Rich Mebius, portfolio manager for Zions Bank Wealth and Fiduciary Services, who will review how the markets are looking to date. I will now turn the time back to Peaches for further introductions.
Thank you, Scott, for setting the stage with your thought-provoking remarks. I will note, following our presentations, we will have a question and answer session. We received a lot of excellent questions from many of you as you registered for this webinar today. And then if you'd also like to use the Q&A feature of the Zoom platform, you can submit questions during the presentations, which we'll try to get to in the Q&A session just a bit later. So our first presenter is Robert Spendlev. Robert is the senior economist for Zions Bank, and he monitors and reports on economic indicators and public policy developments. He has been an economist for 23 years and is bringing forward that expertise for us today. He's known for his insightful and understandable approach to explaining economics. Thank you so much for being with us, Robert. I will turn the time over to you.
Great. Thanks, Peaches. It's great to be with you today, and great to have this economic market update. I'm just going to share my screen. Let's see. Oh. There we go. Can you see that?
We've got it. It's beautiful.
Great. So I just want to get into a little bit more depth of kind of what Scott talked about. You know, today, just this morning, President Biden had a news conference talking about some of these struggles that we're having. In his statement, he said, inflation is my #1 domestic policy priority, and there's a reason for that. So what I want to start with is kind of the what we're seeing happening, and then talk a little bit about the why. So let's start off with the Fed. Like Scott mentioned, last week, the Federal Reserve raised their federal funds rate. Now, the federal funds rate is really the only rate that the Fed directly controls, and it's the very shortest term rate. It's the overnight rate for borrowing. And the Fed raised it up to 75 basis points. You can see that we had an extended period of essentially zero rates following the Great Recession. We started to see those rates going up again as the economy was improving going into 2020, and then the pandemic hit, and the Fed dropped those rates all the way back down to zero again. In addition to the rates, the Fed also went through a series of what they call quantitative easing, or increasing the size of their balance sheet. They essentially doubled the size of their balance sheet. So they were dropped rates down and were purchasing mortgage-backed securities and treasury securities in very large numbers. Now, this is essentially showing, so the last one was what the Fed did. Then the next question is, what is the Fed going to do? And so what this is looking at is every other meeting, the Fed makes a prediction of where they think it will be appropriate for the federal funds rate to be going forward. So what I did was I took the last 4 meetings where they've made these forecasts and threw them all together. So the blue line is June of last year. The green lines are September of last year. December is of last year is yellow, and then our most recent one in March is gray. And just look at the number for 2022. Essentially what the Fed was saying 1 year ago, the Fed was saying it will be appropriate for us to keep interest rates at 0 throughout all of 22. By September, they've raised that and they said, okay, we're going to raise rates 1 time in 22. By December, they said, okay, we're going to 3/4 or 75 basis points by the end of 22. What are they saying today? And remember, we're at 75 right now. Now their official forecast is they're saying they're going to be at 175 by the end of 22 and up to 275 by the end of 2023. So they've had a major change in where they say they're going to go. Now, again, kind of pay attention, 175 and 275 is where the Fed is officially saying they're going to go. What do the markets think, though? This is looking at the federal funds futures. So while the Fed says they think they're going to go to 1.75, the markets think that by December of this year, the Fed funds rate is going to be closer to 3%. And by this time, or by about a year from now, it's going to be up to nearly 3.5%. So even with the Fed's aggressive pivot, the markets are expecting that the Fed will have to raise rates even more than what they've said. Now, the reason for that is inflation. The Fed has what's called a dual mandate. The Fed's mandate is to focus on 2 things: price stability, or another way to say that is low inflation. and then also full employment. So let's talk about the inflation real quick. The Fed's specific goal is 2%. That's their kind of stated policy goals. They want inflation to be 2%. And you can see that for a long time, it did hover right around that 2% level. For 20 years, it hovered around that 2% level until last year. It started to take off. Now we're at 8.5%. This is the highest inflation that we've seen since 1981. But if you look at it a different way, the last time we saw this high inflation and it was going up was in the 1970s. So we're really going back to around 1978 when we've seen inflation this high that was going up. So the next question is, when will the inflation peak? Tomorrow is going to be a critical day for our inflation. The consumer price index, which is what we're looking at, will get a new reading tomorrow morning. And the big question among economists is, when will this inflation peak? We know that in the 1970s, that inflation didn't peak until March of 1980, and it peaked at 14.8%. So are we near that peak now? Or are we going to see that inflation continue to move up? So question number one is, when does it peak? And then question number two is, after it peaks, how low will it drop down? Will it get back down to that 2% that the Fed wants, or will it settle out at a higher level? And that would make the Fed's job much more difficult. When we kind of break down some of the components of this inflation, it becomes really remarkable what's happening. So in blue is that same inflation number that I just showed at 8.5%. But for the mountain region, the region that we live in, that inflation is even higher. It's coming in at 10.4%. So we have not only is the inflation nationally at the highest level we've seen in decades, the mountain region has the highest inflation in the country. So we're much higher than the rest of the country. There's also another interesting trend. You see that this inflation really started March of last year, but then right around July of last year, our region started to take off, and we started to see that higher level of inflation than the nation as a total. And that's a trend that you'll see several times with these inflation graphs. So that's kind of the top line inflation. What about our core inflation? So one of the things the Fed does is they strip out food and fuel, and their argument is that food and fuel are volatile. And so if you want to look at kind of the non-volatile or the less volatile components of inflation, you should look at core inflation. So that's what we're looking at here. But even when you strip out that food and fuel, our core inflation at the national level, 6.5%, so more than 3 times as high as the Fed's target. And in the mountain region, our core inflation is at 9% currently. But let's look at food. So when you look at the food inflation, you can see that it is going up dramatically in both the mountain region and the US. We're right around 9%. And if we dig into this food inflation a little bit more, you see that the biggest area that's pressuring that inflation is meat prices. Meat prices nationwide are up nearly 14%, in our region up over 17%. So that's really having an impact with those essential food products that people rely on. And that is having a big impact on that overall inflation. What about fuel? Another area where we're seeing big increases. Again, kind of took off around the beginning of last year, and we continue to see much higher prices. For the US on the mountain region, we're right around 45 to 50% increase in fuel prices over last year. Oil prices in the last few days have come down a little bit, but we're still above $100 a barrel for oil prices. And we're right at least on a nominal basis, we're at an all-time high in our gas prices at right around $4.30 to $4.50 per gallon. Now, the one kind of bright spot is it does appear that we may be seeing peak inflation in fuel, but we haven't seen those increases or those inflationary pressures starting to come down yet. Another area is housing. And this is kind of a tough one because the Fed, the Bureau of Labor Statistics collects this data, and they don't have a good measure or a good accurate measure of actual housing inflation. And the reason for that is they don't view buying a house as a consumption. They view it as an investment. And so what they do is they compute, or they have a figure of what would be the equivalent rental price if you were to rent out the house that you live in. And that's how they come up with this housing inflation. So we do see that that housing inflation is also up much higher at the US level, up 6.4%, mountain region up 9.7%. But if you've just looked around lately, you'll notice that actual price increases are much higher than this. And that's what we show with this one. So looking at actual home prices. So this is looking at the typical home, and we're looking at the US, Idaho, and Utah. The typical home price in the US is now $337,000. But in Idaho, it's now $470,000, and in Utah, over $555,000. And we can see how dramatically those prices have increased just in the last couple of years, where nationwide prices are up significantly. But again, we've kind of seen that take off with Utah and Idaho seeing much higher home prices and home price appreciation. If we look at that growth rate in those prices, you see how dramatic that is. There is one kind of glimmer of what we're seeing. Remember, we're looking for that peak inflation. And just to put some context on this, if we go back to the Great Recession, or before the Great Recession, the housing bubble of 2005 to 2008, you can see that really showing up strongly, where the US topped out right around 12% appreciation, Utah topped out around 15%, and Idaho topped out around 25%. Where are we now? Much higher than that. The US is over 20%, Utah is about 30%, and Idaho topped out around 36%. But we are starting to see, at least in Idaho, we're starting to see some signs that those housing price appreciations have peaked and are starting to come down. We haven't seen that peaking in Utah or the US yet, but I expect that we will be seeing that relatively soon. The reason for that, this is a great analysis that the Financial Times put together. So when you combine that dramatic increase in home prices with the increase in mortgage rates, it starts to have a big impact on the cost of those or the mortgage payments necessary for those homes. So last week, Freddie Mac reported that the average mortgage rate in America is now 5.25%. I expect that when we get the new data this week, it will be even higher, probably close to 5.5%. And then you couple that with higher home prices, the average mortgage payment has gone up by about $500 to $600 a month. Just assuming the same price house, those mortgage prices to maintain or pay those mortgages have gone up dramatically. And then kind of looking at, what do we expect over the next little while? A way to look at that is the producer price index. So we've been looking at the consumer price index, the prices paid by consumers. What about the prices paid by producers? And we see that the latest measure of producer price increases has been 11.2%. So even higher than that 8.5% for consumer prices. So there's upward pressure on producers, and producers really have no choice but to pass along those increased costs to consumers. And so there is upward pressure. There continues to be upward pressure on producer prices, and we haven't seen that peak inflation on producer prices yet. Now, remember I mentioned that the Fed's dual mandate is inflation and employment. So what does employment look like? The employment sector is actually looking really good. At the national level, we added over 400,000 jobs last month. It was the 12th consecutive month of more than 400,000 jobs added to the economy. We're very close. We're about just about 1.2 million people away from reaching our pre-pandemic high that we saw in February of 2000. And I expect if we continue to see this kind of growth for the next few months, we'll pass our pre-pandemic high this summer. The unemployment rate is very low. So if you look at this shaded area, 4.5% to 5% is generally considered to be full employment. That's the target. Where are we today? We're actually below that, which is why we're seeing labor shortages. The unemployment rate, it's great to see the unemployment rate dropping until it gets below that full employment level. And this is why we're seeing labor shortages and struggles to find employees. To put this in perspective, this spring, 4.5 million people quit their jobs. It was the highest ever recorded. Right now, there are 2 job openings for every unemployed person. And so the biggest struggle right now is employers finding people to work for them because that unemployment is so low. However, even with that high demand for workers, our labor force participation is lower than it was pre-pandemic. It should be, with all this demand, we should see this labor participation going up, but instead it's stuck below the pre-pandemic levels, and last month it actually ticked down a little bit. And so that's one of our biggest struggles, is that people are leaving the labor force even as the demand for workers is very high. And the result of that is wage pressure. And we once again saw a very high wage pressure coming in at 5.5% last month. Now, one of the struggles with this, though, 5.5% year over year wage increases is very high wage pressure. However, if you compare this 5.5 to that inflation of 8.5, real wages are actually dropping. So wage growth is not keeping up with inflation. And if employers raised wages enough to keep up with inflation, then it would cause inflation to go even higher. In fact, we have a name for this. It's called the wage price spiral, where wages are chasing prices and then prices have to go higher to maintain those higher wages. That's what caused that extremely high inflation of the 1970s. And that's what the Fed is trying to fight. Looking regionally, our region is looking really strong. Like Scott mentioned, Idaho had the highest population growth in the country over the last year at 2.9%. Utah and Montana right behind Idaho at 1.7%. We're also right in the center of the fastest growing region of the country. We're seeing very strong population growth, and we're continuing to attract a lot of people to move to the Intermountain West. When we look at employment growth, also very strong. So this is looking back to pre-pandemic, February of 2020, how states have recovered from the pandemic job impacts. Utah leads the country in that. Utah has actually added 5% employment since the beginning of the pandemic. Idaho right behind that at 4.9%. You compare that to other states like New York, which is still down 4.8%, and Hawaii, which is still down 9.6%. So there really is a big difference in how states have recovered from pandemic employment impacts. When we look at the unemployment rate, again, Utah is tied for the lowest unemployment rate in the nation at 2%, tied with Nebraska. Idaho very close to that at 2.7%. But this is one of those struggles where that very low unemployment rate is making those labor shortages even more difficult and is producing a strain on overall economic growth. And then going to that labor force participation, this is a really interesting one. So there's that green labor participation of the U.S., where it's still lower than it was pre-pandemic. Utah in blue and Idaho in yellow. So Utah is close to being back to where it was pre-pandemic with its labor participation, and we're seeing it moving up. What's been very surprising to everyone has been Idaho, which not only saw the pandemic hit, but then has been trending down during the recovery period. And now Idaho's labor participation is lower than the US. And what this is really showing, it's a reflection of who's moving into Idaho. There's very high migration going on in Idaho, and many of the people moving into the state are not part of the labor force. And so it's pulling that labor force participation down as the population changes and a different kind of migrant comes into the state. When we look at kind of pulling it all together, looking at our outlook, looking at COVID, well, there's still a lot of struggles in other parts of the world. Overall, COVID is looking very good in America. I think, and so it's a positive trend. Our economic growth is going up, so that's a positive trend. We did have a setback in GDP last month, but I think at least for the next couple months or the next couple quarters, our economic growth will continue to be good. So I'm putting that as a positive trend. Our job creation is very strong, and so that's a positive trend. The unemployment rate, I put that as neutral. It's low, but I think it's too low. I think it needs to be it starts to come up a little bit so we can address that labor shortage. Wage growth, it's great for the individual, but it's really creating problems with our inflation and is creating that inflationary pressure. So that I put that as a negative. Our labor force participation is coming up. I'd like it to come up more, and I'd like to see more people coming back into the labor force again. Consumer confidence, it is just not great right now. People don't feel great because of that inflation. The inflation is too high, and we haven't seen that peak yet. I'm really hoping we'll see that peak inflation when we get the data tomorrow. Housing prices are appearing to peak, but we'll have to keep watching those numbers. And then interest rates are going up. The Fed has to do it to slow down this inflation, but it will slow the overall economy as they try to bring down or cool off that overheating economy. With that, thanks so much for having me, and we'll go back to you, Peaches.
Thank you, Robert. As always, a lot of really interesting and timely information. We very much appreciate you sharing with us. If I may, a couple of follow-ups on inflation before we get to our Q&A. I know a bit after, before we pivot over to Rich. What broad impacts of high inflation that we're experiencing? What can we see kind of immediately and downstream, the impacts of this inflation? We've received kind of related to that. Is the Federal Reserve working on bringing this down? Why not deflation? We're seeing this question come in going forward. General ideas there?
Yeah, it's a really tough issue. Until a year ago, we weren't even thinking about inflation. Inflation had kind of gone into the background of what people were thinking about. And so it's a new problem that we're trying to figure out. If you remember, 9 months ago, when this inflation first started to pop up, the Fed called it transitory. They said it would go away on its own. They said it was the result of temporary supply chain problems. And what we've found out is this inflation is much more widespread, and it's much more persistent than the Fed had expected. And we are seeing those impacts very broad, whether it's on housing prices now going into rental prices. The inflationary impacts on fuel is really impacting all the goods that we receive, because fuel is a vital input into everything, because how do we get the goods that we receive without it being shipped to us? And then just those broad supply chain struggles that we're seeing. The Fed mentioned they have the ability to impact demand, and increasing interest rates will impact demand. They really don't have the ability to impact supply. they can't fix the supply chain problems. They can't reopen those supply chain problems. And so they will continue to struggle with this. Now, the question about deflation, that's definitely possible. And that's actually the biggest concern. We've seen deflation twice in the last 20 years. The first time was the last time oil prices collapsed in the fall of 2014 and spring of 2015. Oil prices went from $100 a barrel down to $26 a barrel, and we saw some brief deflation there. But the big one was the collapse of the housing market in 2008 and 2009. And that was what perpetuated and exacerbated the Great Recession. And so as bad as high inflation is, the worst thing that can happen is we start to have prices falling dramatically and have a widespread deflationary environment that could really be destructive to the economy.
Mm-hmm. Yeah, that makes great sense. Thank you for those insights. I know that there's also quite a few questions specifically, again, related to this inflation about why in our region. So our region seems to be seeing higher inflation than others, as you described, especially in maybe food and housing. I'm just wondering, is that a direct relationship maybe that we're experiencing having the highest inflation and likewise also some of the highest rates of employment? So our people are working, are folks feeling they have to work to afford to live in our regions? Is that why we're seeing those two numbers kind of going together? And otherwise, why is our region so much more inflated?
Yeah, no, great question. So if you think about inflation, inflation is a byproduct of a very strong economy. And it's essentially a sign of an overheating economy. And so we're seeing that those inflationary pressures around the country, but the Western region has the strongest economy in the country. We have such high demand for employees that we have to increase wages. We have such high demand for housing that it increases those prices. We have such a strong market in the Western region that it's pushing those prices even higher. And so it's a struggle that is directly related to the strength of the economy.
Mm-hmm. Great. Thank you so much. I appreciate you taking a couple of those straight away. Thank you again, Robert. And as we are kind of pivoting, I'll let you, Rich, pivot as we switch our slides over here. I'll just note while we're doing that we will be sending a link to the recorded webinar and the presentation materials as soon as they're available. We've gotten that question in the chat as well. And so I'm excited to introduce our next speaker, Rich. Rich Mebius is a portfolio manager for Zion's Wealth Management, and Rich has over 16 years of experience in the financial services industry. He works with high net worth clients, institutions, nonprofit organizations, and other entities, helping them implement investment strategies to meet their goals and manage risk. So thank you so much, Rich, for being with us, and I'll turn the time over to you.
Okay, great. Thanks a lot, Peaches. Let me just make sure you can see this okay. Great. Yeah, thanks again, and happy to be here and talk with our clients today about the market and go over really what we're seeing in the market. Today is no exception with market volatility. We're kind of fluctuating between whether the market wants to be positive or negative for the day to try and end some losing streaks that we've had in the market. So wanted to focus a little bit, not so much on the first quarter. I think a lot of us know what the first quarter looked like, trying to make our slides as up to date as possible. So right now, what I've got on the screen, these are market returns through yesterday. And as you can see, it's been one of the most challenging starts to the year for investors. We're somewhat used to corrections. What we're not used to is seeing corrections across the board, certainly in the stock and bond market at the same time. We're kind of calling this a nowhere to hide market. As we look across these various asset classes, you see there's really hasn't really been any place to hide. The bond market has been challenging, especially for those conservative investors, where you're seeing returns between muni bonds and high quality bonds down about 10% for the year. The biggest drawdown that we saw in stocks was from January 4th, where the S&P 500 and the NASDAQ hit their highs. Since then, the S&P is down 16%, and the NASDAQ is down 26% from to the trough. We did get quite a few questions that were submitted earlier about gold, and just thought I would address that as we're looking at returns. Gold does fall in the commodities category that you see there. However, the biggest driver of returns in commodities is really energy and agriculture. Gold is up for the year. It's up about 2%. But it did peak in early March. And since early March, gold is down over 11% since then. Kind of goes against the idea that gold is a safe haven and an investment or an inflation hedge, with it being down as we're seeing that spike in inflation. Just another asset class, don't have it up on the chart. But earlier in the year and last year, the cryptocurrencies was a big topic of conversation. Bitcoin hasn't really proven to be that safe haven either, as that is down almost 30% for the year. So truly a challenging environment for investors. When we look at really what a diversified portfolio looks like, where there's some combination of stocks and bonds, what we're looking at here, some of you might have seen this in the past, but we're looking at the S&P 500 and the Bloomberg Aggregate Bond Index, and looking at returns between either of those groups, quarterly returns going back really since 1976. And what you see is the majority of the time, both stocks and bonds are positive. About 38% of the time, you do see that come in. And then the next frequent is where stocks are positive, bonds are negative, and then vice versa, you'll see bonds positive where stocks are negative. But the vast majority of the time, about 81% of the time, at least one of those asset classes are positive in a quarter. Unfortunately, we are in that bottom section where both are negative for the year. Most investors have some form of a 60-40 portfolio or slight variation of that. And so we wanted to look at some of the data just to illustrate where the markets are. And when we look at the monthly data through April, you'll see that a 60-40 portfolio is down through April about 12% for the year. You really have to go back to the financial crisis in 2008 to find a time period that's similar to what we've experienced so far through this year. When you look at the chart, though, on the bottom and you see the rolling 4-month changes, I think it is important to point out that even though we are down, some sort of a diversified portfolio, in this case, that 60-40 split, the batting average is pretty good. If you look, it's been positive the majority of the time. We just happen to be in this time period where both are negative, but it does have a pretty good track record there. Switching gears now to earnings, right through last week, about 87% of the companies in the S&P 500 reported earnings for the first quarter. And when we look at the S&P, they're kind of in the middle. About 79% of those reported earnings were above the mean estimate. The mean estimate, or excuse me, the 5-year average is 77%. So as bad as that the first quarter feels from a market standpoint and looks when you look at your statements, companies are still doing well. They're above their 5-year average, and overall earnings have exceeded estimates by about 5%. Normally, though, when companies report a beat on earnings, the stock has been up 0.8% the 2 days before to 2 days after announcing. Right now, with that volatility and uncertainty that we have in the market, companies that have beat earnings are down 0.1% over that same time period. So, again, companies are just not being rewarded for that beat because of the uncertainty that we have right now. And part of that uncertainty is with companies that are reporting outlooks for the rest of the year. Now, not every company reports guidance for the rest of the year, but those companies that do have issued weak or negative guidance for the rest of the year, just adding to that volatility. And as a result of that, this is just the second time in the last 7 quarters that analysts have lowered their earnings estimates. You can see on the chart that some of the biggest contributors to the positive surprises are industrials, consumer staples, technology, and healthcare, where some of the detractors there is consumer discretionary, missing on those earnings. Year over year earnings growth are led by energy, materials, and industrials. For the outlook the rest of the year, second quarter earnings are expected to be up 4.8%, just over 10% for the third and fourth quarter. And then analyst expectations for the full year is slightly above 10% earnings growth. Just make a note also while we're on the subject about valuations. Last week, with the decline in the S&P 500, we saw that the forward PE ratio dipped below 18. It was at 7.6. The last time it was below 18 was before the major part of the pandemic of 2020. And it is below the 5-year average of 18.6. We're still, however, above the 10-year average. The 10-year average is 16.9. But, between market volatility yesterday, we're not too far from that, where we could potentially dip below that 10-year average. So from a valuation standpoint, the market is getting more attractive than it was just a few months ago. Okay, looking at the bond market, wanted to talk a little bit about the yield curve. And if you go back to your finance or economic classes, you'll recall that when bond values go down, the rates or yields move higher. And with bonds in correction territory, you would expect yields to be higher. And that is what you're seeing here on the yield curve. So in green, that is the yield curve that was plotted out at the beginning of the year. The blue is as of yesterday. And you can see that the spread in that 2-year has been extremely dramatic. And the 10-year is right around that 3%, kind of varies by the day. So that is essentially what the market is expecting that Fed funds rate to be, is around that 3%, right around that 10-year treasury. It is interesting to note, though, that when you look at that yield curve, the 20-year is pricing in some of the highest yields on the treasury yield curve. And when we do have US auctions of treasuries, we are seeing significant demand in those longer term treasuries, specifically that 20-year, both domestic and international buyers. So it does show that even with a lot of the global turmoil, that the US is still considered to be a safe haven. And especially with those higher yields, it becomes more attractive. With that increased demand, it could help keep a lid a little bit on those yields. When we look at the municipal bond, the municipal bond yields, this is another area that has traditionally been safe for investors, but it has not been spared from the correction. So as a result of where bond prices are, the yields on muni bonds or tax-free yields is extremely attractive. We haven't seen these yields since 2016. There was that short spike during the pandemic, and that was before quantitative easing came in. But you'd have to go back to 2016 to really find these sustained levels of yields. For existing bondholders, the decrease in value is certainly painful, and it's just going to take some time to work through those current holdings to take advantage of the higher yields. For new cash, this could be an area of opportunity as these tax-free yields have moved higher, and also taking advantage of huge outflows that we're seeing in muni bond funds. Okay, just wanted to wrap up with some concluding thoughts here. The market is trading right now on really three things that are all kind of interrelated and is looking for some clarity. So the first one is inflation. Like Robert said, tomorrow the government will release the CPI number. The expectation that the market is looking at is that inflation hopefully peaked in March, and April CPI coming in at 8.1%. From March is 8.5. But do expect some volatility tomorrow. It could either be up or down depending on what that number is and the trend behind those numbers. Next then is the continued Russia-Ukraine war and how that's adding to just global instability. It's also adding to inflation and really recessionary fears globally, which also brings us to the last item that the market's kind of looking at, and that is lockdowns in Shanghai. Really that's causing some issues on the supply chain front. Just as that was easing, those shutdowns have really put a hamper on the logistics and getting goods back into consumers' hands. The bad news is that the last two items, those last two bullet points are sort of priced into the market. The good news is that any relief in any of those areas would be seen as positive and could send the markets higher. I did look back at bear markets going back since 1950, charted the peak to trough declines, how long it lasted, and then how long it took to break even. There is some debate right now about whether we're in a bear market or just a correction. For the NASDAQs and small cap stocks, we're definitely in a bear market territory. The S&P, it's not quite clear yet. But regardless of what you want to call it, bear markets are normal, but it's always painful. When it feels like it couldn't go lower and it does go lower, and then you kind of get to this capitulation where it just feels that the bottom's going to fall out and a total crash. That's not what we're expecting. Bear markets do happen, and no one knows how long they're going to last, but they do eventually come to an end. If you look at the last three bear markets there on the bottom, you'll see that they lasted less than a year, and the recovery back to break even was less than a year. I would also point out that if we look back to 2008, looking at a portfolio that was 60-40, that recovered in about 3 years versus just the S&P that took a little over 4 years to break even. Certainly not calling a bottom here. There's still a lot of unanswered questions. However, for investors, having that well-diversified portfolio and a plan for cash flow plan or a retirement plan can help stay the course, even when times are uncertain like we have right now. And with that, I will turn it back to Peaches for some Q&A.
Thank you, Rich. Again, such great insights and information. We appreciate you. We received a lot of great questions, both in advance and real time. So we'll jump into responding to some. But Rich, coming off of your content, we'll start with this one directly related, which is, what about gold or Bitcoin as investment options? Would you be able to speak a bit to these for us?
Yeah, I kind of mentioned earlier about the returns in gold and Bitcoin, and those have been, again, challenging investments. Goes back to that idea of there's really nowhere to hide. Gold, I think, is a little more unique, where the traditional thought is that gold is that inflation hedge. But since it peaked in March, it's gone down 11%. So it does make it hard to say that gold is going to hold value if there's inflation. Generally, what we see is when everything is in a correction territory, all things correlate back to zero, meaning everything moves together. So the challenge with gold, at least for a lot of clients, is there's no earnings and there's no dividend or interest that you get from those investments. Where stocks or bonds, even if that value fluctuates, you can still get some economic benefit on an ongoing basis. Bitcoin, we still see as speculative. It trades more like high growth stocks rather than a safe currency. And so, again, on that one, it's going to be a proceed with caution. Certainly when the times are good, it's great. When the times are not so good, then people really wonder why they got into those investments.
Great. Thank you for that. I appreciate that, Rich. Robert, in way of questions, we'll go to you for a couple here. I know you spoke quite a bit and you supported some questions on inflation just before you wrapped earlier, but we did get another come in live based on Ppi and Cpi coming out this week. What can we be looking for to understand if inflation has peaked?
Oh, great question. So, this is a way for the economist nerd in me can come out. So there's, we mostly focus on the year over year change, but we also have month over month change. And so, part of that forecast, like Rich mentioned, we're expecting that CPI, the year over year, will come down from 8.5 to 8.1. But the really big one that I'm going to be watching is that month to month. So last month, the monthly change was 1.2%. Is the highest monthly change that we've seen in 40 years. If it comes in below that 1.2, then we might see a sign of that peaking. Also, we'll be watching that core inflation very closely too. So we kind of look at that year to year. So if that 8.5 drops down a little bit, that's one sign. And if that month to month comes down below 1%, now that's a good sign. If that month to month is negative, that would be a clear sign that we've peaked. But one of the other things that that we need to caution everyone is there can be false peaks. If you look at the inflation of the 1970s, we saw some false peaks on their way up. And so 1 month of data will not be enough to know for sure. But at the very least, we need to see that year-to-year number come down and that month-to-month number come down significantly.
Mm-hmm. Awesome, thank you. And for the caveat, what for us to pay attention to. Oh, sticking with you though, Robert, we got another one for you here. How high do you expect interest rates will go? Is the Fed tightening enough? And how will increasing interest rates overall impact the economy? And Rich, if you have comments on this too, we can come to you after Robert on the same question.
So this is the real struggle. And this is where the Fed has been so far behind the curve. They thought they really wouldn't have to raise them at all a year ago. And every time they meet, they get more and more and more aggressive. And I can tell you what the Fed in the meeting last week, Jerome Powell kind of gave some indication of where they're going to go. So they raised that federal funds rate by 50 basis points. That was the largest increase in 20 years. And they essentially said, expect another 50 basis points in their next meeting in June, another 50 basis points in July. They don't meet in August, but I would suspect that in September and through the fall, they probably won't go with 50 basis point increases, but they're going to do a series of 25 basis point increases. They want to see what the impact is on the economy. And this is the real struggle. It's this balancing act. They know they have to go fast and they know they have to go high, but if they go too fast and if they go too high, it will slow the economy. And they run the risk of pushing the economy into a recession. So they're trying to orchestrate this soft landing. They're trying to slow down the inflation, slow down the economic growth without causing a recession. And I'll tell you, it's going to be a struggle. The Fed has been able to orchestrate soft landings in the past, but not when they were chasing inflation. Where they've been able to slow down the economy, it's when the inflation was already low. Essentially, every time historically that they've had to fight high inflation, it has caused a recession. And so the probability of one is pretty high in the next year.
Which is exactly what's going to be our follow-up question that we received quite a bit of is, do you see a recession on the horizon?
Rich, do you want to jump on that one?
Yeah, I'll address that from the wealth management standpoint, and also
Wonderful.
add that the Fed also not only do they have the ability to raise rates, but they're also looking to unwind their balance sheet, which can also have a tightening effect and move rates higher. I think that there's a lot of power that they have with that. They're going to start reducing that in June with minor amounts, and then they've indicated that they could do unwind more. But that's going to be another powerful tool that they have. And again, all of it is to try to slow that inflation down, as Robert said, without tipping the economy into recession. We do agree that with some of the Fed speakers that, inflation is not, recession is not our base case. We do expect the economy to continue moving. Markets, at this point, we're still expecting equities to finish the year positive. So it's not a base case scenario, but certainly there are some challenges that are widely outside of the Fed's hands. Those supply chain constraints is a big one. And generally when we've had recessions, it's some of it's the Fed reaction, others is a major shock to the economy, either in the US or globally. And so that's always a scenario that should be in the back of our minds. But again, it's not our base case.
Thank you, Rich. And I'm mindful we're down to just a minute. I want to have a couple closing comments and what to set expectations for our viewers. But Rich, any initial quick comment as to what investors should be doing in case there's recession or, God forbid, market crash on the horizon?
Yeah, the best advice that we have right now is we really pride ourselves at Zions on our advice and our guidance. We spend a lot of time getting to understand our clients, what the needs are, and our overall philosophy is getting clients the returns they need. I should say the long-term returns that they need with the least amount of risk. Right now we're in an uncertain time, and that's where that advice and that guidance is really valuable. And so we would encourage you to reach out and just make sure that you understand where you're at, and again, maintaining that diversified portfolio.
Thank you so much. And thank you to Scott, Robert, and Rich, all of you, for your remarks and presentations. We appreciate your timely outlook for the second quarter of 2022. Your insights really do help us to keep up with market trends and help our bankers and our clients make informed decisions. Thanks also to our production team for today's event, Heidi Prokop, Jared Van Leuven, and David Todd. We appreciate you all. If any of you have any follow-up questions for Robert or Rich, we'll keep this slide up for just a few minutes here with their contact information. You're welcome to reach out to them directly if you like. And then, as I mentioned earlier, following our session, we will send out by the end of the week or so a recording of the presentation. And immediately after, Zoom will present you with a survey. We'd love and appreciate your rating of the effectiveness of today's seminar, capturing any comments or questions you might have as well. We post our videos and offer other reports online at zionsbank.com/economics. So please check that out anytime you like. Thank you so much for your business and for continuing to trust Zions Bank with your banking needs. We appreciate you spending this time with us and hope that you found it valuable. We will continue to host webinars like this one and hope that you'll join us again soon. Thank you, everyone. Have a fabulous rest of your day.